Market cap tells you what equity is worth, but if you're buying the whole company, you need to know what comes with it. This is the MadBrooks professor. AI generated, not financial advice. Charlie, you cover mergers and acquisitions almost daily. When AT&T announced they were buying Time Warner for $85 billion, every headline ran that number. But that wasn't what AT&T actually paid. Walk us through what that number actually meant.
The $85 billion was the equity value, what they paid Time Warner shareholders for their stock. But Time Warner carried about $23 billion in debt on its balance sheet. AT&T didn't just buy the company, they assumed responsibility for that debt. So the actual check they wrote was $85 billion, but the enterprise value, what they really paid for the entire business, was closer to $108 billion. You're buying the assets and the liabilities. The debt follows the assets.
And that distinction matters because when you're comparing companies or looking at valuation multiples, you need apples to apples. Let's build this from the ground up. Enterprise value is market cap plus debt minus cash. Market cap is shares outstanding times price per share. That's the value of equity. But equity sits at the bottom of the capital structure. Above it, you have debt holders who get paid first. If I'm buying the whole enterprise, I'm taking on those obligations. The debt adds to what I'm effectively paying. The cash reduces it because that cash is coming with the business. It's sitting on the balance sheet, and I can use it. You're buying a company with $10 million in the bank. You're effectively paying $10 million less for the operating business.
Exactly. And this is why you see different multiples for different metrics. Price to earnings, that's an equity multiple. You're dividing an equity value by net income, which is what's left after you pay interest on debt. But EV to EBITDA, that's an enterprise multiple. EBITDA is earnings before interest, taxes, depreciation, and amortization. It's a proxy for operating cash flow before you pay debt holders or the tax man. You're looking at what the business generates before the capital structure matters. That's why when I'm comparing two companies in the same industry with different leverage, EV to EBITDA gives me a cleaner read than PE.
Let's test that with a real scenario. Take two telecom companies. Company A has a market cap of $50 billion, no debt, $5 billion in cash. Company B has the same $50 billion market cap, $20 billion in debt, and $1 billion in cash. Same equity value, radically different enterprise values. Company A's EV is $45 billion, 50 minus 5. Company B's EV is $69 billion, 50 plus 20 minus 1. If both generate $10 billion in EBITDA, Company A trades at 4.5 times, Company B trades at 6.9 times. Same market cap, same earnings at the EBITDA line, completely different valuations once you account for capital structure.
And this shows up constantly in coverage. I remember when Tesla was being compared to Ford a few years back. People would say Tesla's market cap dwarfed Ford's, so the market was saying Tesla was worth more. True at the equity level, but Ford carried enormous debt from financing operations and their credit arm. If you looked at enterprise value, the gap narrowed considerably. You weren't just comparing two car companies, you were comparing two different capital structures. Tesla was funding growth with equity, Ford with debt. The equity holders were pricing in different risk and return profiles.
That capital structure reflects strategy and constraint. Utilities carry massive debt because their cash flows are stable and predictable. Regulators let them earn a return. They can service debt without much risk of default. Tech companies, especially younger ones, often carry little to no debt. Their cash flows are volatile. Their assets are intangible. Banks won't lend against intellectual property the way they'll lend against a power plant. So they fund with equity or they hoard cash. When you see a company with net cash, that's cash minus debt. It tells you something about the business model and the cycle they're in.
And it affects how you think about returns. If I'm a private equity firm buying a company, I care about return on equity because I'm the equity holder. I might lever up the business, add debt to the capital structure, because debt is cheaper than equity, and I can juice my returns if the business performs. But if I'm a strategic buyer, someone buying a competitor to integrate it, I'm thinking about the cash flows I'm buying relative to what I'm paying on an enterprise basis. I need those cash flows to cover my cost of capital across the whole structure, debt and equity.
Let's talk about how this plays in different industries. Software companies with recurring revenue, high gross margins, they trade at high EV to EBITDA multiples. You might see 15, 20, 25 times. Investors pay up because the revenue is predictable and margin expansion is possible as they scale. Retailers, restaurants, they might trade at 6 to 8 times. The cash flows are thinner, the competition is brutal, the margins don't expand the same way. But you can't just compare the multiples without knowing what's in the capital structure. A retailer with sale-leaseback agreements, where they sold their real estate and lease it back, might look like they have less debt, but those lease obligations are economically similar to debt. The new accounting standards make you capitalize leases now, but you still need to know what you're looking at.
That's where the footnotes matter. I covered WeWork's attempted IPO, and the thing that jumped out was how they talked about community-adjusted EBITDA. They were adding back not just standard items, but also marketing costs and other expenses, trying to make the cash flow look better than it was. Meanwhile, they had these long-term lease obligations that were essentially debt. The enterprise value looked absurd relative to any honest measure of cash generation. The market sniffed it out, the IPO collapsed. But the lesson was clear. You have to look under the hood. The headline number, the valuation they wanted, didn't match the economic reality of the obligations and the cash flow.
And that gets to why this matters for anyone trying to understand value, not just deal makers. When you read that a company is expensive or cheap based on some multiple, ask which multiple. Is it price to earnings or price to sales? Those are equity multiples. Is it EV to EBITDA or EV to revenue? Those are enterprise multiples. They answer different questions. If a company just took on a mountain of debt to fund a buyback, the market cap might shrink, PE might look better, but the enterprise value hasn't changed. You've just reshuffled the capital structure. The business is worth the same. You've just allocated it differently between debt and equity holders.
And in a rising rate environment, that reshuffling has consequences. Debt gets more expensive. Companies that loaded up on cheap debt when rates were zero now face refinancing risk. Their equity might get hit because the debt service eats into free cash flow. The enterprise value might hold, but the equity value can get hammered. You saw this in 2022 when rates spiked. High-growth tech companies that were valued on distant cash flows, they got crushed. But some of that was also about how much cash they were burning, and whether they'd need to raise more equity or debt at less favorable terms. The capital structure wasn't just a footnote, it was central to the investment thesis.
Last thing, when you see a company trading below its net cash position, meaning the market cap is less than cash minus debt, that's a red flag or an opportunity. Either the market thinks the cash is going to disappear, management will waste it, or there's a hidden liability, or the market is wrong and there's value to unlock. You have to figure out which. But you can't figure that out if you don't know how to build enterprise value from the pieces and understand what each piece tells you about the business and the risks. See you Friday. Enterprise value is what you pay. Market cap is just what the equity costs.